It's in the middle of the day on a Wednesday. I think people will probably be catching this replay. So I'm going to get started to respect the people that are here. I'm Pranay, one of the founders of Ascent Equity Group. And today I'm going to be talking about debt. As Peter likes to mention, debt is a double-edged sword. Actually, let me see if I can. One sec. Okay, so as Peter likes to mention, debt is a double-edged sword. So it improves your returns, and we'll use an example shortly, but it also increases your risk. And typically, returns and risk go together, right? Or at least it should. The higher risk you have in something, the higher returns you should ask, right? So we always want to make sure that our risk adjusted returns are as high as possible, right? So something like a treasury T-bill, which a 5-year is about 4.2% right now, that's relatively risk-free, right? Because if the treasury bill fails, that means the US government has failed. And it's not completely out of the picture, but it's pretty low. While something like crypto, you would expect a much higher return, maybe 20, 30, 40%, right? Compared to the treasury bill because you're getting so much risk, right? You're assuming that some of your investment is probably going to lose money. So the rest of the investment needs to make up for that, right? So when thinking about that, let's talk about an investment property. So you're buying $1 million property, right? And let's say it has a yearly rent of $100,000. So that's a 10% cash on cash, which is basically impossible to find these days. Let's say you found a unicorn that gives you 10% cash on cash from $1 million, right? So if you paid for this whole $1 million with 100% cash, you're saying you got a 10% return, right? But now, let's say instead you put down for the $1 million property, you put a down payment of 200K, and you're getting rent of 100K per year. Now your cash on cash is actually 50%. 50%, right? Cash on cash. So cash on cash is how much income you're getting, right? So let's say 100K divided by how much money you have in the deal. So this one is 200K, right? So 50%. While this is 100K divided by 1 million because you paid all cash. All cash. So your cash on cash is 10%, right? So obviously these are different properties, right? You wouldn't expect to have a property that is having a rent of 100,000. You would have mortgage payments, you'd have expenses, you'd have a lot of other things that you would have to pay. You would have to pay, but this is just a simplified instruction. So the question would be, if you see this, why not pay the lowest amount possible, right? So maybe you put down, instead of a 200,000 down payment, you put 100,000, right? And now this number is 100,000, and this number 100%, right? Basically, you're making all of your money back in a year. So that means starting year 2, It's all gravy. Every single dollar you're making is profit, right? While these chumps are only making a 10% return on their money. It's gonna take them 10 years to get to what you're gonna get in a single year, right? You make all your money to ROI, right? Return on investment. You're gonna make it all in 1 year. While here, you're gonna get it in 10 years. So this, right, if we're strictly looking at this, it looks good. However, here, right, what are my chances of losing the property? Very slim, right? Some expenses from utilities, right? Some property taxes. So, relatively minimal, probably less than 10% of the property. Some maintenance. So maybe let's say 10 to 20% of the property. Because the biggest expense you normally have is from your mortgage payment, right? So all of us that own a house, we know every month bank has to get paid, right? Well, here, one. So here, right, I have all this same stuff, but then I also have a mortgage payment, right? So that means my loan for this 100K is for $900,000, right? And let's say that's at 7%, which is what the going rate is right now. That means I am paying 63,000 a year, right? So divided by 12, get my calculator. So 5,250 per month, right? On this cash. So it'd be really hard to have the 100K left over after that to make these numbers work. Just assume it's true. So that means every month I gotta pay this. And if it's making, let's say, 100K in rent, 100 divided by 12, that means it's making 8,300, right? So to make these numbers work, I gotta assume that you're actually have to make, so now if I have to cover this, right? That means I gotta make this money plus 5.250, right? So I actually got to make 13,583, and I get, this is how much I have to collect, right? This is profit. So just to break even, and this is maybe, let's say 10%, so maybe 2,000 a month, right? So here I have to only make $2,000 to cover all this stuff. While here, and actually I didn't even include all this stuff, right? So it's actually 15,000. So here's the difference, right? And if it's a good year, everyone is paying rent on time. It's fine, right? I'm covering all this stuff and I'm making all this rent. But what happens if I have some vacancy? What happens if rents go down? The risk is that because my loan is so high and there's nothing, if I miss a month, it's gone, right? So usually lenders will work with you if you got to miss a couple months before they'll take a property back. They don't necessarily want the property back, right? But the higher your leverage is, so here the leverage or LTV is 90%. And I'll talk about what LTV is in a second. But the higher the amount of my loan is, right? So 900K compared to 7% versus, right, 800K, right? So now I'm putting back this 200, but also my profit, right, goes down to 50%. But now 7 times 8, right, 56,000. And then so my payment every month, right, 56,000 divided by 56 divided by 12, 4,600, right? So double-edged sword. When time is going well, taking leverage may make sense, but you actually want to have this at a reasonable amount, right? So there's kind of two ways that we look at leverage. And they're called LTV and LTC. So because I know all the numbers off the top of my head, I'm going to use sunrise and check, which is about 94% full. So LTV, loan to value. To value. Now, how much is my loan, right? Compared to the value of the property. So for example, the loan that we're gonna get on Sunrise on Chandler is about 30 million. The value of the property is 49 and a half. We're buying it for 46. So let's figure out the loan to value. So 30 divided by 49. It's about 60%. Right? Then you have LTC. So loan cost, right? So this is a number that looks at how much is everything going to actually cost together, right? Compared to the loan. So because we're actually bringing the renovations, we're paying it ourselves, right? The loan to cost is going to be 30 and the renovation budget is about 3 million. So it's going to be 49.5 plus about 3 million. Do some math. 49.5 plus 3. So actually, we're buying the property for 46. The value is 49 and a half, but we're buying it for 46. So it should be about the same. So 30 divided by 46. It's about 65%. LTC on the property. So these are numbers. So the question is, how do you really determine what a correct number is? So ranges I've seen are anywhere from 50% to about 80%. So the type of loan that we're getting called agency debt. Agency. And those are through Fannie Mae and Freddie Mac, both government agencies. They will only give you up to about 67.5 of your LTV of your value, right? So 49.5 times 0.67.5. So it'll give you about $33 million on this property, right? Doesn't mean that you have to take the full amount. You can actually take as little of it as you want. Well, you have to take a certain amount. They have a minimum. I don't think they want you to go much lower than 50%. Because then it's not necessarily worth their time, right? You can't borrow like 2 million from them. They want to put out multiple millions at the same time. But they say we feel very comfortable lending this amount. So we actually like to go around here. Our personal kind of sweet spot is 65 to 70% is where we like to be. So So, they have this magic formula that they figure out how they're going to use to determine that, right? So typically they're actually in the 55 to 65 range. So what we'll do sometimes, like we're doing on Sunrise on Chandler, is we will add a little bit of preferred equity. So what it does is it adds an extra couple $1 million. So our actual LTC is going to be 69 and a half. And that's where we feel very comfortable at. So we think you could probably push this to the 70s and still feel pretty good. Because if you think about it, most of us, when we buy a house, we get a loan of 80%, right? And we put a down payment of 20% down. Most of us feel pretty good about that. I actually put down 15% because I got a doctor's loan. So that means my loan is 85%. But it's also at 2.37%. So I felt very comfortable taking as big. I actually would have taken a down payment of 10% if they would have let me, but they didn't. So we are going to put a down payment of around 30.5%. So we feel, that is a lot bigger than this one. And even for most investment properties, people would put down set 25%, and we're going to do 75%. So this is a lot, this is a lot bigger. Remember, this is times 46 million. So it's a pretty large down payment of around $20 million. And this includes the renovation budget as well. So we think, anywhere from 25 to 35% down payment, the more the better these days. Makes us feel very comfortable in debt. And it's looking at, how much risk, because you can always pay all cash, right? But you're going to get, a single digit return, which is very similar to what you can put into a treasury bill. So why would you take the risk of investing in real estate if you're only going to get a single digit return? So we like to add a little bit of leverage, knowing that we're working with the government and having it for a reasonable amount. When we think, at least for Sunrise on Chandler, around mid to high 60s is kind of where we like. And you've seen. So let me use the current owner as an example, right? So the current owner has a loan for 50 million. And they're all in is 60 million. So, and the property is worth by a broker 49.5. So they're what you would call underwater, meaning they owe more on the property than what it's worth. And that's why we're actually getting this property for so we're getting it for 46 million. So unfortunately, the current owner is going to lose all of their equity. But real estate it's a zero-sum game. So one person has to take a haircut for someone else to win. And they're a big billion-dollar bank, so I don't feel too bad for them. But what they did wrong was they got a way too big loan. They got a variable rate loan. So remember I mentioned earlier about a 7%. Their interest is in the 9% plus. And that just makes it so much of a difference because in the example I showed earlier, it was 4,600 compared to 5,200. And that's only for 900K property, right? Now, if you multiply this by 50, right, to get a 46 or almost $46 million property, these numbers are going to look a lot bigger, right? The second mistake they made was they got a mezzanine loan. So they got they actually got a variable rate loan, but they wanted to get more leverage up to, let's see, they got to up to 50 divided by 60, about 83%, right? 83% loan. So they got a second loan on top of their first loan. So 1, 2, and the interest rate on the interest rate on the second loan is like 15%. And they do that because it's riskier, right? It's riskier because you're the second loan, right? They call it junior loan or mezzanine loan. They call this the senior debt because it's senior in position to get paid, while this is second, junior or mezzanine. So this interest rate is really high. So if you average these together, they're paying like 12% plus. So their debt payment on a, let's say $50 million loan times 0.12. 50 million times 0.12. That's 6 million. 6 million in debt payments a year, while we have a $30 million loan times 0.06. Ours is 1.8 million. No, 0.0, sorry, 6%. Our loan payments is 1.8 million. 1.8. So, people wonder how we're able to cash flow immediately. It's because, I guess that's kind of too low, huh? Let me write that higher. So 12% would be 6 million per year. And 6%, 12% of 50 million. So 30 million times 6 million is 1.8 million. So this is why we're able to cash flow immediately, because our debt payment, not only is our amount less, right? The amount is less compared to them, right? Our interest rate is a lot lower. So, and it's fixed, so it's not variable. This can change. Like if interest rates go up, which they're probably not likely to do, but it can go up. You always have that kind of above your head worrying that's going to happen. Ours is going to be fixed at this amount of 6%. And that's pretty good. I think right now, if you go to buy a house, it's 7 or 8%, at least for the next 6 months. So that's kind of a quick overview of how debt works on a commercial real estate side. I mentioned that we have a fixed rate loan. We only have one loan. It's through Freddie Mac, Fannie Mae, who gives you the best terms, but they're not going to give you a ton. They're not going to get you 75, 80% of the leverage, which is fine with us because we don't want that. And we got to about 69.5 LTC total all in. So if anyone else has any questions, I don't see any in the chat. I'll be here to answer anything. But thanks for joining me. That's a little bit about debt in terms of commercial real estate. Think of any questions. Oh yeah, thanks for the poll. Yeah, please answer the poll if you have a second. Let me think about what else I can talk about for debt. In terms of debt, it's very important to talk about who is guaranteeing it. So it's kind of a roundabout way to figure out what role the person you're investing in is in the project, right? So some people will raise capital for a project, but won't be, skin in the game of being on the loan, and we sign on our loans. Okay, so someone is asking about returns, so talk about that. Oh, and then one last thing I want to mention about variable versus fixed loans. So you see this and you're like, why would anyone ever do variable rate? So one, they close fast. If anyone has done anything through the government, you realize it's super duper slow, right? Two, they give you more leverage, right? So if you're having problems closing a deal, right? Here you got to bring in, almost half of the money, right? So it makes properties a lot more expensive. 3, no prepayment penalties. So these people are happy to get their money back in a couple years, while these people, they don't. They say, we did all this work up front to vet you, to underwrite you. We don't want your money early, right? So we have a 5-year fixed loan. That means they don't want the money in 3 years or 2 years. What they do to discourage that is they charge us a fee. And the fee goes down after every year, but they make it not appetizing in the beginning couple of years to sell. So sometimes it still makes sense, but the downside is typically I tell people to only invest when they have the money that they expect to be in for 5 years. Yeah. Okay, so returns for Sunrise on Chandler. So equity multiple. Basically, if you put in X amount, how much of a multiple are you going to get? 1.8 to 2x. So if you put in 100K, we think that's going to turn into 180 to 200K. And this includes the original 100K. So it's basically an extra 80K to 100K. Right? And that's after all the fees. IRR, so this looks at how quickly you're going to get your money back. It's 14 to 16%. Yeah. Annualized rate of return. Annualized rate of return. Basically, how long is the deal going to be? How much am I going to make in total divided by how many years, right? So about 200K divided by 5. So it's about 17 to 20%. But you make most of that money when we sell the property, right? Because we're doing a lot of renovation. And then lastly, cash on cash. If I invest 100K, how much money am I going to get every year? It's going to be 3.5 to 5.5 in the first year. And oh, can you see that? Let me write that. I keep writing it too low. Okay, so cash on cash, 3.5 to 5.5%. So if you put in 100K, you'll get about 4,000 in the first year, and goes up about 500 to $1,000 every year. So, it goes up about a 0.5% to 1% every year, and that's it for the returns. Yeah. So expenses. So run, a 177 unit, there's a lot of expenses. So I assume you're probably talking about fees. Our fees are actually pretty streamlined. There's a 2% acquisition fee. In the first year 1. There's a 2%. There's a 2% management fee starting year 2. There's a construction management fee of about 100K, and that's split between all the investors. And highly unlikely. So like I said, we're probably going to be in this deal for 5 years. If for some reason it is a good idea to refinance, there's a 1% refinance fee, because the government is very difficult to work with. I mean, we have to hire a bunch of consultants and stuff to make this happen. So that's it. Some people will charge a dispo fee, which is a fee charged on being sold, but ours, we don't do that. That's it. Those are all the fees. There's no extra layer of fees. Some people will charge multiple layers, right? There's like a property level, a sponsor level, but these are all our fees. And then there's a property management that goes directly to property management, and that's 2.5%. Yeah. And then the property itself has expenses, right? Payroll, maintenance. We have a reserve for like appliances. We're doing renovations, about 12K per unit for renovations, and so on. Okay, let's see. Is there a chance that all the money could be lost? So there is always a chance of losing money on real estate, really any investment. So I don't think anyone could tell you that there isn't. But I think right now there's three risks, and I'll tell you how we've tried to mitigate it. So one, interest rate risk. So January 1, so actually let me go backwards a little bit. 2022, there's something called the dot plot. And basically all the heads of the Federal Reserve will say how much they think interest rates are going to move and in what direction. No one, zero, said it's going to move over 2.5%. And we all know it went up 5%, right? So these are experts. They're literally the head of the Fed, right? So interest rates, people say they're going to fall. On January 1st, they said there was going to be 6 rate cuts. So far, it's June, and we've had 0. They think there might be 1 rate cut this year. So interest rates, there's just no way to predict what's going to happen. So to take that off the table, we got a fixed rate interest rate loan, right? So it's fixed for 5 years. And at least it makes the biggest expense predictable. The second risk, called execution risk. You have this grand business plan and you go in and buy the property and it's crap, right? There's a lot of skeletons being in the closet. They put in whoever without any credit checks just to show really great occupancy, and it sucks, right? The reason that this property is not doesn't have that is Sunrise has been operating this deal for 2 years. This is our 3rd deal with them. So we have a unique look in the mirror or look into the finances and know that, you know, there's almost no evictions. The bad debt is 0. It's 97% occupied. And very rarely do you have this kind of insight. Usually you just, you know, you do your best due diligence and then pray a little bit, right? But here we know they've been running it very well. And then 3, and this has been happening across our portfolio, expenses have gone through the roof. And the biggest expenses outside of your mortgage payment is your property tax and your insurance. So all of you who own a home, you probably notice your insurance has been crazy. And the nice thing about specifically Phoenix is that your property tax increase is capped at 5%. So throughout the whole city. We have states where we have investments where property tax went up 30% in a single year. There's really not much you can do against that. You can try to litigate, but then you're spending more money, right? The other thing is because Phoenix doesn't have any natural disasters, the insurance quotes and per unit have been very reasonable. Unlike Florida, when one of our properties, our insurance went up 3x, or even in Texas, where you have to worry about, you know, frozen pipes and hurricanes and all that stuff. So because of these 3 things, we think that the property is pretty insulated. Of course, it can't be 100%, but we feel very insulated from losing any money on the property. And you know, people will ask, what is the biggest risk? I think the biggest risk is if we head into a major recession, right? But the property, before we touched it, it's making 1.6 times, and that's called debt service coverage ratio. Debt service coverage ratio. And it's making 1.6 times how much the expenses are. So revenue is 1.6 times, and that's before we've done any renovations or anything. So we feel like we have a pretty good buffer in case things go wrong. Banks, even agency, they only require you to have 1.25. So we feel very comfortable with that. Okay, so Adrian talks about why not keeping the property. So that's a viable option. However, most of the value in the property is from selling the property. So instead of us keeping that property, so Peter had a property where they did a cash out refi and they just keep holding on to the property, but the property is worth a fortune. We actually think that you're better stewards of your money. So if a property is worth, you know, 1.5x or 2x. We'd rather sell it and then you can decide, because we have people of all different types, people that are close to retirement that want to take that money and use it to live, while we have other people that are like, hey, just let it ride. So we would prefer to give that money back to you, and then you could put it into another investment if you want, or you can use it. So we actually think better to cash out, take that money, and use it, or either as an investment or to live life, as opposed to having it trapped, right? Because what if you decide to keep it in the property and then you hit a bad cycle, and then that value that you had is gone, right? So if we have a good opportunity to sell. So Tiffany mentioned what happens to the investor if there's a loss. So if there's a loss, right? So you have a capital balance, right? So if you say put in 100K, this is what uh your value could be down to zero. Now, if you used some of the depreciation, you might have to pay some of that back. So you got to get into kind of the weeds. But typically, unlike other things, if the property is sold at a loss, and very rarely is something sold at a total loss. It does happen, but it's pretty rare, like less than 2% in the last couple of years. So you might have a small loss, but remember, we are currently, the property's cash flowing, it's doing very well, and we haven't even touched it yet. They ran out of renovation money years ago, so we're gonna go in, we're gonna do renovations, we're gonna make a nicer gym. So we think the value is gonna increase a lot, not just organically, right, expecting the market to get better, but forced appreciation. So we think that we are gonna cause a lot of appreciation, so the chance of losing any money is pretty slim. Yeah. So someone wants the replay. Yep, definitely gonna send it out. So thank you everyone. And Sunrise in Chandler. Oh, last deal. Okay, so the returns that I mentioned are after all the fees. So 1.8 to 2x your money, 14 to 16 IRR, cash on cash, average around 5%. Yeah, these are after all fees. So we always like to mention things that are after fees. So it's just easier to understand. Some people will inflate their numbers and give you numbers before fees, but we think that's a little sketchy. So if we sell at the end of 5 years, maybe we could 1031. It's going to be difficult because the value of the property, right? Like, so let's say doubles. It's going to be hard to find $100 million property within 45 days. So we'll consider it. But what we like to and what we recommend is often called a poor man's 1031, where you get into another deal and you use the depreciation on that deal against the gains on this one. So it's not 100% deferral of taxes, but you're deferring most of the taxes. You have to get a little bit more into the weeds, but for most people that's better, because then you can even use some of that money, as opposed to 1031, where you have to put in all the money into the next deal, and actually all the investors has to go from one deal to the next. Yeah. Okay, and then lastly, yeah, so people can we are going to look at other deals. It's probably going to be our last apartment deal for the year. We are looking at other preferred equity deals, kind of like Metro Park, like our last deal. So we might have one of those in the near future, probably a couple months. And you cannot increase your investment after the deal is closed. When it's closed, it's closed. We can't take any more investment, and all distributions will go to you. You can't really put it back into the so it's nice, right? You kind of forget about it, and I forgot to mention it pays monthly, right? So we'll close probably in a couple weeks, mid-July, and then first check will go out in like a month and a half, after we get the finances. Cool. Awesome. Thanks, everyone. I will chat soon and we'll send out the replay. Bye.